the news for Europe just keeps getting worse.
The French government collapses, plunging EU's second largest economy into turmoil.
France's political upheaval in December offered another glimpse at fractious European affairs.
Germany's under pressure and Volkswagen workers are striking hard.
In my view, we are already...
Europe is in decline. Europe is in crisis. Europe is falling behind the United States and China.
In 2008, the United States and the European Union were nearly equal in economic size. Today, the U.S. economy is trillions of dollars larger. This wasn't a sudden shift. It was a structural divergence. Over the last 15 years, the United States outpaced Europe in growth, productivity, energy production, technology scale, capital depth, and military capability. The gap widened quietly. Now, it's measurable. This is not a cultural argument. It's a power comparison. And the data is not ambiguous. In 2008, the United States and the European Union were economically comparable in size. U.S. nominal GDP was roughly $14 to $15 trillion. The European Union was slightly larger, at around $16 trillion. At that point, they were operating at near parity. That balance reversed. By 2024, according to IMF estimates, the United States economy exceeds $31 trillion, while the European Union stands closer to 22 to 23 trillion. The U.S. economy is now roughly 40% larger. The gap exceeds $8 trillion. This is not a short-term fluctuation. It reflects sustained differences in growth rates. Since the financial crisis, U.S. real GDP growth has averaged around 2 to 2.5% annually, while the EU has averaged closer to 1 to 1.5%, with prolonged stagnation in several major economies. A 1 percentage point growth difference, sustained over 15 years, compounds dramatically. Compounding explains the widening structural gap. Per capita output reinforces the divergence. U.S. GDP per capita now exceeds $85,000 in nominal terms. The EU average is closer to $35,000 to $40,000. On a purchasing power parity basis, the gap narrows, but the United States still maintains an advantage. PPP reflects domestic price levels. Nominal GDP reflects global financial scale and capital weight. For geopolitical leverage, nominal scale matters. IMF medium-term projections suggest that if current trends hold, this divergence continues through the remainder of the decade. In 2008, the United States was still a significant energy importer. That changed dramatically with the shale revolution. Over the following decade, U.S. oil and natural gas production surged. By 2023 and 2024, the United States was producing roughly 13 million barrels of oil per day, the highest level in its history. It also became the world's largest exporter of liquefied natural gas. Energy, at that scale, changes industrial economics. Domestic production lowers input costs for manufacturers. It reduces exposure to external supply disruptions. Europe operates under different constraints. The European Union imports a substantial share of its energy. Before 2022, roughly 40% of EU natural gas imports came from Russia. When that supply was disrupted, energy prices across Europe spiked sharply. At several points during the 2022 to 2023 energy crisis, European natural gas prices were multiple times higher than US prices. For energy-intensive industries, chemicals, steel, heavy manufacturing, those differences are decisive. Higher energy costs reduce margins. They influence investment decisions. They affect long-term industrial competitiveness. The United States, meanwhile, benefited from lower domestic gas prices and expanded LNG exports to global markets. Energy independence does not eliminate volatility, but it reduces structural vulnerability. Over time, lower input costs compound into competitive advantage. Growth is not only about innovation, it is also about cost structure. And in energy, the United States holds a structural edge. Today, the majority of the world's most valuable technology companies are American. Among the largest global firms by market capitalization, Apple, Microsoft, Alphabet, Amazon, NVIDIA. The overwhelming concentration is in the United States. Europe has large corporations, but it has relatively few globally dominant digital platforms at trillion-dollar scale. The difference becomes even clearer in artificial intelligence. The most advanced frontier AI models have been developed primarily by US-based companies. The largest hyperscale cloud providers are American. The most advanced semiconductor design firms are American. Scale matters in technology. Training advanced AI systems requires enormous computing infrastructure and capital expenditure. The United States concentrates both. Venture capital reinforces the gap. Annual venture investment in the US consistently exceeds that of the European Union by a wide margin, often more than double. Larger funding rounds enable companies to scale faster, acquire competitors, and expand globally. Europe maintains strong universities and research institutions. It produces high-quality engineers and scientists. But the commercialization layer, the global platforms that dominate data, advertising, cloud infrastructure, and AI deployment, remains heavily concentrated in the United States. Technology compounds, just like capital. The region that scales platforms first often captures the majority of network effects. Over time, that translates into pricing power, data control, and geopolitical influence. Industrial strength supports technological leadership. Technological leadership reinforces economic divergence, and that divergence continues to widen. The United States operates the deepest and most liquid capital markets in the world. Total US stock market capitalization is significantly larger than that of the European Union's combined exchanges. American firms raise capital at scale, both publicly and privately. US venture capital investment consistently exceeds that of Europe, often by a multiple of 2 or more in strong funding years. Late-stage funding rounds in the United States are typically larger. That allows firms to scale aggressively before seeking profitability. Capital depth changes risk tolerance. In the United States, pension funds, institutional investors, and asset managers allocate substantial capital into equities and growth assets. That fuels high-risk, high-reward innovation. Europe's financial system is structured differently. It remains more bank-centric. Corporate financing in many EU countries relies more heavily on bank lending than equity markets. Capital markets are also more fragmented across national jurisdictions. Fragmentation limits scale. Deep, unified capital markets accelerated. The result is visible in corporate size. American firms dominate global equity indices. European firms are underrepresented in high-growth digital sectors. Capital is not just money, it is fuel for expansion. The deeper and more unified the market, the faster firms can compound. Technology leadership reinforced growth, but capital markets made that leadership scalable, and scale is where divergence becomes structural. Demographic momentum has also diverged. The United States maintains stronger population growth, while much of Europe faces faster aging. A growing labor force supports expansion. An aging workforce slows it. Over time, population dynamics influence economic scale, and economic scale influences something even more powerful: monetary architecture. The United States issues the world's primary reserve currency. The US dollar accounts for roughly 55 to 60% of global foreign exchange reserves. The euro accounts for roughly 20%. A majority of global trade, including energy trade, is invoiced in dollars. Oil, Natural gas, commodities, and many financial contracts are priced in U.S. currency. This creates structural advantages. Global demand for dollars lowers U.S. borrowing costs. It increases liquidity in American financial markets. It strengthens the depth of U.S. Treasury markets. It allows the United States to finance large fiscal deficits at relatively favorable rates. The euro is a major global currency, but it does not operate at the same scale of global reserve dominance. Currency dominance also enhances geopolitical leverage. Financial sanctions, payment systems, and global liquidity channels are deeply integrated with the dollar system. Economic scale supports currency dominance. Currency dominance reinforces economic scale. That feedback loop strengthens structural advantage. Monetary architecture is not visible day to day, but over time, it shapes financial power. The United States spends significantly more on defense than any individual European country. In recent years, U.S. defense spending has exceeded $800 billion annually. Collectively, European NATO members have increased spending, particularly after 2022. But deployable power projection remains heavily dependent on American capability. Within NATO, the United States provides critical backbone functions: strategic airlift, advanced intelligence and surveillance systems, carrier strike groups, global logistics infrastructure. European militaries are modern and capable, but integrated large-scale expeditionary power remains concentrated in Washington. Defense spending translates into readiness, logistics, and deterrence. Hard power reinforces economic influence. The region with greater sustained fiscal capacity can project power more consistently. Economic divergence feeds strategic leverage, and strategic leverage shapes geopolitical outcomes. Europe remains wealthy, technologically advanced, and institutionally stable, but across growth, energy, technology, capital markets, and strategic capacity, the United States has expanded its relative advantage over the past 15 years. This is not a sudden collapse, it is a gradual divergence, and in geopolitics, relative power matters more than absolute strength. Right now, the United States is compounding faster, and compounding reshapes the balance.